Just a quick rundown, like who's this guy? So first of all, on all of your tables, you'll see a printout of all the slides or of the presentation that we're going to go, and it's going to give you guys an opportunity to kind of follow through and write down some notes. If you find anything noteworthy that I'm saying up here. But just to tell you a little bit about who I am, and I just didn't come off the streets and decide to crash the association's party tonight. My name's Darin Hunter. I grew up in Alpharetta, graduated from UGA in 2002 with a banking and finance degree. Got into real estate, right out of the gate. Got in mortgages. I've been in the mortgage industry for 20 years, so I've seen the ups and downs. I've navigated my way through the great financial crisis. And during those periods, I picked up residential real estate, commercial real estate, done the fix and flip thing, I've done the renovation thing. So I've done all things mortgage and real estate related over the last 20 years. And one of the biggest things I've done is really study the market and try to put myself in a good position for myself, of course, but also for my partners that I work with, whether that's agents, whether that's insurance agents, real estate agents, builders, whatever that may be. I'm always looking out for everybody's best interest. Now, in addition to, I do a lot of community service. I'm part of, I've got a nonprofit that I run, which is called Everylink Matters. And that is, I started when my daughter, who's now 5, was diagnosed with a rare genetic disease. So if you want to learn a little bit about that, please go to everylinkmatters.org and check it out. And then I was also on the Planning Commission for the City of Woodstock. My office is located in Woodstock, and I'm also currently the president of the Woodstock Business Club. So involved in the community and doing as much as I possibly can to help educate and learn more and more about the real estate industry. So we're here, the first portion of the presentation, really talk about rates, real estate, and the recession. And some of the buzzwords out there today, we were just talking over here with my man over here, and talking about inflation. Inflation is the arch enemy of interest rates. We've seen inflation come in 8.5%, 9% over the last, at least reported inflation numbers, 8.5%, 9%. And really, you have to remember that inflation erodes your buying power. So if you're in any sort of fixed asset, whether that's a bond, whether it's a treasury, whether it's a bill, if you've got your money tied up for a certain period of time, inflation is eroding that. And the only way to offset that is to increase that yield that you're getting, okay? So remember, price of a fixed asset like a bond, a treasury bill, bond, treasury bill, are all, you have price and rates or yields work inversely. So as price goes down, rates go up, and vice versa. As price goes up, rates go down. So we're going to talk a little about inflation, and then of course the Fed hike. So we just recently had another 3/4 point hike in the Fed overnight funds rate. That is not mortgage rates, that's the overnight lending rate for banks. And we do anticipate the Fed to increase the overnight rate another 3/4, at least 1/2 to 3/4 of a point here in the next couple months. So do anticipate that, but is that good for interest rates? Counterintuitively, yes it is, for mortgage interest rates. And then of course we're going to talk a little bit about the balance sheet runoff. So over the last several years, the Fed has amassed over $9 trillion in mortgage-backed securities and treasuries. It's a huge, massive amount. And one of the topics that they've been discussing is running that balance sheet off. Okay, they planned on running off $40 billion worth of that, putting that back into the market. What they did was 1.5. Okay, so we're going to talk a little bit about that, and then of course the recession. What some of the indicators are, what really determine recession. If you're following the news, it turns out that I didn't know, and we're all learning what the new definition of a recession is. So if you're paying attention, we're going to look at some of the historic indicators that really show and prove that we are indeed, or at least going into a recession. So, and what are the driving factors behind that? Before we do that, we first want to look at, what is the history of the Fed. And if you go to that next slide, you'll see Fed history and see a pattern. If you look at the Fed chairman and what they were dealing with, you've seen a pretty common pattern. They're all dealing with inflation, pretty significant inflation, mortgage interest rates on the rise. Fed, in order to combat that, one of the ways they combat inflation is raising interest rates. So, and that's your Fed funds rate. So they've been increasing in all three scenarios, they've been increasing the Fed funds rate. And then you can see the response. The response has been a reduction in inflation. And then again, as you follow down the chart, you'll see mortgage rates, the mortgage rates continue to drop, but the consequences of that increase on the Fed funds rate is a recession. Just about every single time the Fed has increased interest rates, we've seen a recession. And then also on the equity markets, you've seen 20, 30, 50%. Right now the markets are down 20%, equity markets are down 20%, with more to come. And we've been in a bull market in the equity markets for over 14 years. So are we going into a bear market? To be determined. But we're certainly due. Now, the following chart will have, is really the only data that we have to compare what we're dealing with right now. In the past, the Fed didn't have a significant balance sheet like we do now. Okay, so when they started, if you look back, this goes back all the way to 2016, and is where the data starts. And like we talked about, when the Fed increases the Fed funds rate, you'll see that when you look at this chart, you'll see that the Fed funds rate, when it's increased, the mortgage rates actually tend to tick down. In this one scenario, in July of 2017, we saw the Fed funds rate increase, mortgage rates increased, but when it took hold, you actually saw mortgage rates drop below where the mortgage rates were when the Fed actually increased those rates. It wasn't until the Fed started discussing and actually running off their balance sheet where rates actually start to take off. And when they increased the amount that they were running off their balance sheets is when rates really took off. And it wasn't until the 8th hike that you saw mortgage interest rates, that Fed hike really take hold and do its work, fight inflation, and then again see mortgage rates drop. And you can see as they actually started to stop the runoff of the balance sheet, mortgage rates dropped precipitously. You can see that at the very end, and that's what we've been taking advantage of over the last several years has been these low interest rates. Now going to the next. You may have heard inverted yield curve. So when, one of the indicators of a recession is an inverted yield curve. Your long-term treasuries, the typical one that we follow is the 10 and the 2-year. So is the 10-year treasury higher or lower than the 2-year? If the 10-year is lower than the 2, it's actually an inverted yield curve. So if I'm going to tie up my money for 10 years, I expect to have a greater return than I would if I tied it up for 2 years. That kind of makes sense, right? Greater opportunity for risk, that means I should have a greater reward, so that interest rate, that yield that I should be receiving should actually be higher. Well, right now we have an inverted yield curve, which means the 2s, and actually right now we have the 5 and the 2s, and the 1 is teeter-tottering on that inversion, which shows instability and concern. So if you look to the following chart of the inversions, you can see that every single time that there's been an inversion of the yield curves, and this is the chart that I'm referring to, every single time that we've had an inversion in the yield curve, we've gone into a recession. So, although history doesn't always repeat itself, it certainly rhymes quite a bit. So us being in an inverted situation right now is definitely a sign, a pretty good indicator that we are either in or going into recession. But the one tool that we can't, or one stat that we can't deny with 100% certainty is unemployment. So if you look at the unemployment rate at all-time lows, every time that it's gone from an all-time low and increased in any form or fashion, we have gone into a recession. Now, again, we could sit here and probably discuss how unemployment rates are being determined right now. So we won't, but maybe for another time. But in the White House's defense, we have not seen an increase in unemployment as of yet. So again, we shall see. So. But again, that is one of the most accurate and most reliable indicators is if we're going into a recession. And, is a recession bad for real estate? Is it bad for mortgage interest rates? And counterintuitively, it is not. If you look at this chart here, you'll see where every time we've had a recession, we've gone into a recession with higher interest rates and we've come out of a recession with lower interest rates. So, and actually quite a bit. And so recession, so you would think, so recession's got to be bad for real estate. Well, if you look at the following chart right here, you can see that going into a recession, housing has either stayed stable or increased every single time we've gone in and out of recession, with the exception of one, and that was your housing bubble. Okay, and the difference is, number one, when you have fog up a mirror loans, stated income, stated asset, no job, no credit score type loans, people are buying their primary. They're not only buying their primary, but they're buying their secondary home. They're buying an investment home. The markets were overcooked, there's no doubt about it. And so when that bubble burst, that actually sent us into a recession. Here, in this scenario, the one that we're dealing with right now, is not the case. We're not dealing with a housing bubble right now. We're going into a recession with the housing market doing phenomenal. And so looking at inventory, so we ultimately believe that the market is healthy. And if you look at the record low inventory on this chart right here, you'll see in 2017 we had 3.7 million units for sale. Now we have right at about 870,000. Actually, it's right closer to about 1 million as of today's numbers. So you're dealing with almost 3 million more homes. 3 million more homes were for sale in 2007 versus what they are right now. And then, so again, lots of less inventory. And then when you look at the number of households, you've got 14 million more households formations in 2022 versus what you have in 2007, excuse me. So 14 more million people fighting over 3 million fewer homes. That's a great sign for real estate. Okay, the number one rule of economics is supply and demand. And we certainly are in a great position for real estate. So let's talk a little bit more about the law of housing and supply and demand. So there's no doubt about it. We've definitely seen a little bit of a waning in the demand. Okay, interest rates have gone up. February to June, interest rates doubled. Okay, housing prices have gone up. Affordability has been a little bit more of a challenge. There's no doubt about it. I'm not denying that. There's definitely a market shift taking place. But there just is not a huge increase in inventory coming down the pipe. So let's talk. I just mentioned a little bit about housing formations and how a housing formation is determined. And one of the best things about statistics is you really need to pay attention to the details. When you're looking at statistics and you're looking at economics and what's actually being reported, if we go to this chart where the housing demand and household formations, you can see, and let me just define what a household formation is. So if you're Johnny and you're living with your parents and you go out to buy a house and you turn power on for the first time, that's a formation. If you're somebody that got divorced and you guys owned a house, you both go out to buy a home, that's one household formation. Okay, you're renting a house, you go out to buy a house, that's a formation. Okay, so the distinction is you're not relinquishing a home. Does that make sense? So you're not giving up a home to buy a new one. That's the difference between a household formation. And you can see right now, it's above average, the household formations. So again, for demand purposes, we have more formations taking place, which is incredibly supportive for the demand in the housing industry. So we have household formations on the rise. We have supply that we just mentioned. There's 3 million more formations fighting over, 14 million more formations fighting over 3 million less homes. So how do we create that more demand? How do we create more supply? It's with new construction. And so typically what you would look at is the new housing supply numbers. So we go to housing starts. Housing starts is 1.7 million across the US right now. So on average, 100,000 of those 1.7 million homes are actually destroyed for whatever reason. It's unlivable, doesn't meet code, whatever the case may be. So that leaves us with a total new supply of 1.6 million. We just mentioned that there's 1.4 million household formations, so there's an apparent surplus of 200,000 homes in the US. New homes, new constructions. Again, devil is in the details. Last time I checked, when you put a shovel in the ground on a new construction that you build, nobody's moving into that house. But that's included in the housing starts. Okay, it started, I get it, it makes sense. But what you really want to be paying attention to is housing start completions. And completions are at 1.3 million. With, again, now we look back at that housing destruction. We're at 100,000 homes that are destroyed annually. Now we're at 1.2 million homes, new homes supply. Again, formations are at 1.4. So already a troubled supply issue, it's getting worse by 200,000 units. Okay, which again is super supportive for values in the housing industry. And guys, it's going to take years for this to overcome. We're not just going to all of a sudden build hundreds of thousands of homes are going to come on the market. It's just not going to happen. It's going to take years to build that additional supply, which again is supportive for housing values and supportive for the building industry for quite some time. So one of the things I really want everybody to pay attention is this graph right here. We talked about new supply, but let's look at record low existing home inventory. So recently, if you're listening to the news and paying attention to the real estate markets, there was an increase of about 20% of existing home sales, which is made news, national news. It's the biggest thing since sliced bread. It's unbelievable. It's unbelievable, but yet it happens every single year at this time of year. So why is this year so much different in the housing industry that existing home sales have increased? I'm sorry, the existing home supply has increased. Why is it such a big deal? Because it sells. It sells and it gets people, it's fear-mongering. It's what the news wants you to read. It sells the ads. And guys, it happens year after year. And actually, I did myself an injustice. I should have printed another chart that had a 10 or 15-year data point so that way you could review how long this has been taking place. This isn't just an anomaly. This happens year in and year out. So again, supportive for the housing industry. But speaking of, we just said record low existing homes, even though we just saw a little bit of an increase, okay? When you look at existing home sales, okay, there's right over 1 million units right now. 60% of those million units are actually under contract, which means, again, there's only 400,000 or 40% of the existing home sales that are actually eligible to be purchased. If a house is under contract, I can't buy that. I can put up a backup offer, but I'm not buying that house, right? So again, another data point that just supports housing values and the reason to be in the housing industry. So again, if we go to this chart right here, active existing home listings in the U.S. So you can see at the very bottom right of the chart, you'll see where we just have come off the lowest level in history. We're up about 33,000 units. Guys, to me, that doesn't sound like this a huge, enormous rush of inventory to the market. It just doesn't to me. And there just is a lack of supply. And again, while demand is waning, again, I'm not going to sit here and say that there's not a market shift up here. Again, interest rates are up a little bit. Prices of the homes are up. But we've already seen interest rates starting to trickle back down. We said to hit an apex in June, and we've seen interest rates come back down. And they will continue to come back down. So although we may see some sellers that are listing their house drop what their asking price is, well, that's because they were asking unrealistic numbers. And there's no doubt, last year, year before, they probably would have got it. But right now, they're having to drop the listing price to be more in line with what it should be. And if you were paying attention to the news today, we had a year-over-year increase in appreciation. Appreciation went from 19% to 17%, so a 2% reduction of appreciation. Guys, if you gave me a guaranteed investment where I'm making 17%, I'm going to take that all day long, okay? I mean, give me a break. This isn't depreciation. This is slowing of appreciation. And again, it is a market shift. And it's not healthy for the housing industry to be seeing 20% appreciation on a year over year. It's just not. So a regression back towards the mean has got to happen. There's no doubt about it. But that doesn't mean it's depreciation. This isn't a housing bubble. There's so much activity out there that it is supportive of these values and will continue to be. And one of the last data points I want to talk about is vacancies. So vacancies are at an all-time low as well. If you compare that to 2007, vacancies were at an all-time high. Houses are selling on average on 14 days on being listed for 14 days and under contract in 14 days. So there is no incentive for somebody that owns a house who's under contract on another house to drop their prices significantly to get it off the market. There just isn't, because they know it's going to be sold. There's still enough demand out there and there's still a lack of supply out there that there isn't that incentive to drop that price. And again, one of the reasons vacancy is such an issue or supportive of our values is when you carry a mortgage or you carry a home that is either investment property or second home, there's carrying costs, right? You have a mortgage, you have taxes, you have homeowner's insurance, you have maintenance, et cetera. Well, because vacancy is so low, you're able to rent that property out, you're able to sell that property, whatever the case may be. You don't have that carrying cost. It's not a concern like it was in the past. I'm not saying it's not ever going to be. I'm saying right now it's not that concern because vacancy is so low. People are needing houses. That's one of the reasons why rental rates are up so high. So, in conclusion, this is the MortgageRight, the mortgage hunter, if you will, conclusion. That in my opinion, the recession has been confirmed. Okay, I've given and studied this enough that the recession has been confirmed. We are in a recession, but that doesn't mean the sky's falling. And actually, and I already pointed to the graph where housing does well during recession. So bring it on. That gives us more opportunity. And what that also could mean is that your building costs drop some. So it makes it more affordable for you to build a house. That means your margins increase. Like I mentioned, market shift. If you're building a house right now or you're buying an existing home, you haven't necessarily had to give up closing costs. You haven't had to give up a whole lot of upgrades maybe. Well, be prepared if you haven't. That is one of the things that is changing and we're seeing on a regular basis is borrowers are being awarded or given closing costs and giving upgrades to the buyer. And then again, listing reductions. The sellers are not going to be able to get away with the extreme amounts that they've been asking over these last couple of years. But there is enough activity to keep the value stable. Demand may soften a lot, but supply issues continue to overwhelm, and that means the building industry is going to continue to be strong for years to come. As I mentioned, rates have already started to drop. We hit an apex in June. They will continue to drop. Years ago, I talked about the Fed really not having that ability to raise interest rates. They've sort of painted themselves in the corner because of the $9 trillion that they've amassed on their balance sheet. It was just in my mind, it was just proven that it's such a large portion of our GDP is to interest payments now. So what does that mean? That means they are going to have to reverse course or at least stop what they've already started. Because unfortunately, as a country, we're not going to have the ability to continue to maintain those payments. We're not a country that, at least in my mind, that is going to go into default at any time soon. And that's not something we want to try to do. And so you've already seen the odds of the Fed increasing rates down the road at the end of this year drop. You've already seen the 10-year Treasury, those interest rate drop. Before I got up here today, the 10-year Treasury is down below 2.6. It was just at 3.5. So essentially the markets are building in their future predictors. Bond markets are the future predictors of what interest rates are. And they're expecting that the mortgage interest rates, or rates in general actually, will continue to drop, have peaked and have dropped, at least in the near term. So, why MortgageRight? Why am I up here? Why would you want to work with me? Why would you want to work with my team? What makes me different is one of the things I didn't talk to you about is, I'm not only up here talking the talk, but I'm walking the walk. I'm putting my money where my mouth is. I currently have 3 homes under construction. I have another property I'm closing on August 20th. I have another 10 acres that I'm working on right now for development. So I'm not just up here talking to win you over. I'm actually putting my money where my mouth is. And that is, I believe in this industry. And that separates me from 99.9% of any lender, any broker, any bank that you're working with. I'm playing with my own money. That's what makes MortgageRight different. Marketing contributions. We have the opportunity to work with you to help maintain the margins that you're used to if you're working in the building industry or whatever industry that you're in. We can help contribute towards closing costs. We can contribute towards your marketing, whether it comes to website development, whether it's periodicals, whatever the case may be. We can help with that. Closing cost contributions, I mentioned that. And then, of course, communication. I mean, the last thing any builder, any referral source in any form or fashion that wants to deal with is communication or not being in the dark and not knowing what's happening. We can customize that communication for you to make certain that you're communicating that taken off your plate. So, guys, I'm here to help answer any questions, any concerns that you have. I've been doing this a long, long time. Like I said, I'm putting my money where my mouth is, and I appreciate you guys having me out here. Hopefully I was able to shine some sort of light and didn't bore you too much to death. Unfortunately, the housing market and the statistics behind it really get me excited. So hopefully I did the same for you, but if there's any questions or any concerns, anything I can help answer to you, Mike.